Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. Hope you guys are having a great week and just wanted to give you a weekly market update on the housing market and point out a few things that you might enjoy looking at. We like to bring this to you every week so that we stay on top of what's going on and you're not wondering what's going on maybe from month to month. So we really try to stay on top of these things for you. So real quick, here's some stats, some things just to point out real quick. We're looking at across the board in the greater Phoenix area. We're looking at 26 closed days on market. So that's a pretty quick, brisk market. We've got a 1.21 month supply, which is actually up. We were running, last year, like in 0.5, 0.7%, right in that range. Our absorption rate is 82.82%. So whatever's listed, we're right in that range of absorption. So getting absorbed pretty quick, a little bit slower than it was before. We'll talk about that in a minute. And then our average sales price this week was actually $597,761, up a couple $1,000 from last week. At the end of April, just to give you a quick idea, the average sales price was $591. So we're up a few $1,000s, about $6,000 from that point, a little over 6,000. And then one of the things that was quite interesting was that we had a new set of listings this week of 2641. So 2641 in the past week. Usually we like to be at around 2,500 a week at least in order to kind of maintain the increase that we saw the previous week. And remember, we were hovering around that $9,000 to $10,000 total inventory range. And so we're staying right there. We're actually above it a little bit by about 1,000 or a little over 1,000. And we're seeing our overall inventory then has increased. So that's but that's also staying with 101.66 list price to sales price ratio. What does that mean? Well, that means that properties being listed at a certain amount on the average in the Phoenix metropolitan area. Again, this is for just for Phoenix. We're looking at 101.6, so just over 100%. So in other words, homes are selling for a little bit more than the actual asking price. Okay, so that's across the board. Now, a couple of things I wanted to drill in on real quick here because affordability has become a problem with price increases along with interest rates, of course. And when we look at this kind of in blocks, I'm just going to kind of look at this from zero on up to just up to 499,000. We're looking at a total of 38 days on market and 45.53% of the actual inventory that we're dealing with. Okay, so now when we get to the properties that are going to be priced in at 500,000 all the way up to 999,000, that is going to be 39.7%. And those are going to be sold in about 34 days on market. So that's where the bulk also of the new inventory that we're getting has come on the market most recently. And then a million plus is right around 14%, a little 14.7% of the market over a million. And those are selling within about 77 days, which is pretty quick for that market. So one of the other things that, we keep hearing about is, well, one of the other things I thought was kind of interesting was, we've got 300 more sales than we had last year, with more listings than we've had. And then the last 3 years have been record sales, obviously, for the Phoenix area. If you haven't been paying attention, they've been record sales. And then we had, obviously, 2020 was our banner year during the pandemic, which is absolutely crazy. But in some ways, it makes sense that we've talked about in the past. Distressed is only 0.3%, okay, of the total market available. So that's like nothing. And we've got about 1,000 less buyers. And we look at what's actually gone under contract. We've got about 1,000 less buyers right now, year over year, looking at the same month last year, May, week over same week. We've got from 2021 to now, at the same time, we've got 1,000 less buyers. And from 2022, we've got 2,000 less buyers. Now, obviously, a lot of that's going to be due to the increase in the pricing, and even more so, the increase in interest rates, I think, because, when you go from basically around 3%, maybe even a little less, all the way up to 5 or over 5 now with the federal increases in the interest rate, that's a huge difference. I mean, from 3 to 5%, we talked about this before, you're looking at a 20% increase in your payment. So it's a lot less buying power, a lot higher payment for people. And we're probably going to be that way. I would say again, talking, listen to all the gurus out there, and knowing that we are pretty much in a recession already. They say, 3/4 of negative productivity would put us in a recession. We're heading into that third quarter, but every indication is we're probably looking at a technical recession. And, even with that, we've got these still record sales going on in the market. But we've also got these higher interest rates that are affecting people's buying power. So we'll keep an eye on all that. And then, we see that our prices are still increasing though. So we're still in a very healthy market, especially in the Phoenix area. Now, does a recession always mean that we're going to be heading into issues with equity or prices in the housing market? Well, just to give you a quick rundown here, the answer is no. We've got, in 1980, we saw, this is national, these are some national numbers, but in 1980, we had a 6.1 increase in home equity. In 81, we had, again, during recession, we had 3.5%. Now in 91, we did see a dip of 1.9%. In 2001, we had a recession going on, and we had an increase of 6.6% nationally. And usually when you're looking at these numbers, especially in the last, at least 20, 30 years, if not longer, Phoenix has done better than the national average. But let's just take these national numbers. Again, so 2001 was 6.6%. Now, 2008 obviously was the crash. Nationally, there was a loss there for most people of on average. Again, it was 19.7%. Phoenix wasn't really hit as hard as most areas of the country, but let's just go with that. That was 2008. Obviously, that was tough for everybody. And then in 2020, we had a little bit of an issue, obviously, known because of the known problems of the pandemic. So we had a little bit of a recessionary period there, but we had a 6% increase in the national average. And, our averages here in the Phoenix area have been anywhere from 25 on up, even during those periods, 25 on up to over 30%. So does it necessarily mean that if we have a recession that we are definitely going to have housing issues or dips in equity? No, the forecast right now, when you take everybody together, the Fannie Mae's, the Freddie Mae's, all the different gurus on the planet, and you kind of average it out, they're still saying the forecast across the board for the whole country in 2022 is going to be a 9% equity increase. Now, for the Phoenix area, we're probably looking at right around, I would say, from everything, when you average it together, about 25 to 30%. Okay, I think would be a safe bet for 2022. we talked about before, we were in a super hot market, and we're in a hot market now, because we talked about the CMI before in the past, which we'll talk about again today, of course, but how those numbers have maybe fluctuated a bit. So, these are all things that you have to keep in mind before we go, sky is falling, chicken little, and all that. So, nationally, right now, again, we're looking 6 to 15%, on average 9% is probably going to be a safe bet. And again, around Phoenix for 2022, we're going to be 25 to 30%. So, all of these are incredible. I mean, 5 to 6% is a great equity gain per year. That's pretty much a historic average, especially for the Phoenix area. So, even if it was 10%, that would be, amazing. All right. So guys, over the last 121 months, our, home prices have been going up at a record pace. So pretty darn good run, even if something were to happen where we went down. Now, let's look at, again, we just kind of give you an idea of what all the gurus are saying, clumped together. Here's what the chief economist over at Redfin has to say. I'm going to read this to you verbatim. Housing market thrust into hyperdrive by historically low rates finally begins to slow this year after the Federal Reserve raises rates to fight inflation. The number of homes sold in 2022 declines by something like 10% as housing demands weaken, from those variables. Prices don't fall nationwide, but price hikes do slow, dropping from 20% to, and again, that's a national number, down to perhaps 5% annual growth by the end of this year. Okay. Again, in Phoenix, we're talking about higher numbers like I just talked about, but nationally, this is what this chief economist from Redfin is saying. Home builders, spooked by the slowdown in home demand, scaled back their construction plans. Now, a couple of weeks ago, we talked about how our permits have actually increased here in the Phoenix area for new builds. Now, again, I think I also mentioned to you a couple of weeks back that in order for really builders to keep up, and back in 2008 when we had that crash, they were way overbuilding. I mean, we were like 2 to 3 million ahead of where we should have been, where normally they want to be about 100, maybe 100,000 to 1 million ahead of where they want to be. In other words, to keep up with the future demand, because it takes, 6 months, probably more now with all the labor and supply shortages, a year, 14 months, 10 months at least to build a property in most cases. So they need to kind of be ahead of it. But our permits have gone up, and I'm not going to get into the details of that today for this video, or all the reasons why we had the crash, back then. Of course, now we have more regulations, more equity, all those sorts of things that we talked about before. Plus, supply and demand is always the big thing, right? We had more supply back then, is the point, than we do now, as far as that goes. New builders and resale. So, and they finally so they're talking about this across the board. Some builders are timid, even though our permits are increasing. Even in Phoenix, they're a little bit timid on what they should do. Because of what's happening with the recession coming up. And finally, she says, this chief economist says, and finally, all of this comes to a head a couple years down the line when a renewed demand for homes once again meets a market with too little inventory to sell. In other words, at some point, we're going to get to a point where it's because the builders are a little squeamish. They're still building, but they get this little bit of a slowdown because they're worried about overbuilding, and they have labor and supply shortages. That'll change in the future, where there's going to be this high demand again. Also, remember, and I've mentioned this before in the past, yes, interest rates are high right now because of inflationary factors. They're really behind the 8 ball in getting those higher interest rates going. And some of this, in my opinion, is manufactured with some of the inflationary factors that we're seeing. Not to go down that rabbit hole, but the point being that most of our economists would also say that, hey, when we do hit that recession, after about a year, 18 months, maybe 2 years at the most of being in that recession, probably not that long, but you're going to see interest rates drop again. Why? Well, they've kind of made up some of that backfill in, the bond market that needed to be taken care of with the higher interest rates due to the inflation. And now they have to lower interest rates because we'll be in a bad economy, in a recession. So usually when you're in that long enough, they'll lower interest rates. They will lower interest rates in order to counteract that issue. Okay. So when that happens, again, people will go back to buying. We'll probably have a low supply still. People our demand will go back up every year, right around tax time in spring. Early summer, people, that's usually the buying frenzy. So we're going to see all that cycle through and happen. So again, we don't need chicken little skies falling here. We need to keep an eye on things and know what's going on for sure. But that's what they're saying. So now we want to look at the Crawford Report and what it says here on list success rates. The list success rates. So it says to watch listings, okay, because inventory is still low, remains low. To watch listings, and again, this is for the Phoenix area, success rate in selling when listing. Okay, right now we're at about 90%, but we've had a slight drop from where we were. Okay, and it's starting to go down, and it's continuing to go down. In 2005, we were at 63%, just to give you an idea. So that would equal 1 in 3 houses actually sold. So that was more of a buyer's market. We're still in a seller's market, but more of a chance for buyers to get their offer accepted and under contract. So we'll have to watch that. So again, we may see soon with that factored in, possibly some seller incentives more often. From the seller, we may, we talked about it last week, we're at about 3%, instead of usually like 25%. We may see, a little bit of extra time on the market, possibly, instead of, multiple offers with 10, and that's kind of what we're seeing now, instead of, 10, 20, 30 offers like we're seeing before with crazy, spikes in prices. You see a little bit lower of those price hikes right now, and with the lower demand that we're seeing. And I'll get into that here in a minute, but we'll also see that kind of leveling off for a period of time. So since Crawford Report has had this CMI, this Crawford Market Index, since the year 2000, shows supply and demand issues of what's going on. And so the CMI, if it's between 90 or 110, it's in a balanced market. Anything over 110 is a seller's market. Anything below a 90 is a buyer's market. So right now, we are sitting at 315. In February, we were at 470. Okay, so we're at 315. In February, we were at 470. So it's dropped considerably. So we've gone from that super, super crazy hot market to still a hot market. Our demand is changed quite a bit. Again, at rates and prices, we're at 98.3%. So we're 2% below the normal, which would be 100. But technically, the normal is between 90 and 110. So we're right there in that range. But the supply is at 31.2. So we're about 70% below the norm. But that's up 10 points since January. So we got to keep an eye on that. Demand is down, and we've got the rates and some price, reductions due to the rates and the slowing of what buyers can afford or what they're willing to pay in a payment. And then we've got the closing costs and things like that we talked about, seller incentives. So some of the other factors here and cities to look at is, you know, the month over month average is at month over month, we're 15% down. The average is at 24%. Okay, so as far as the CMI, the index, it's down on average 24%. Last month it was 20.5%. And the 4 cities that had the biggest drops were Avondale at 30%, which puts Avondale at a 381.3 CMI. Gilbert had a 34% drop. So that's a 319.5, and Cave Creek was at 20, it's a 200, it's at 279.7. That had a 30% drop. And then Queen Creek was coming in at 227.2 on the CMI on that index. When you look at that city, and that is down 36%. So we got to keep an eye on all this. But previously it was down, like I said, 20.5. Now the average is 24%. And we're down month over month by that to 15%. So overall, but those are the 4 cities: Avondale, Gilbert, Cave Creek, and Queen Creek, where we had a lot of creeks where we had those issues, right, with the biggest drop. So let's look at the, we're going to be going down a little bit faster, or we're seeing, kind of a faster drop with the Crawford Market Index. Last year, we kind of saw it dip down. This year, we're seeing a little bit more of a sharper drop. Again, a lot of that's due to, the prices are higher, but the interest rates, again, we're going from 3 to 4 or 4 to 5, again, you're killing it. We're actually over 5 now. So when we go from 3 to, let's say, 5.5 on an interest rate, that's a 25% hit to your mortgage payment. That's a big deal for anybody. So it's a lot less buying power, a lot more money you're having to put out, whatever the case may be, or less you can actually afford to buy in the first place. So we're seeing a considerable drop, but we're way off from, again, the woes of the 2008, the sky is falling, Chicken Little people that are worried about that. And, rightly so, I can understand why, but we're still at that 315 mark on the CMI. Back in 2008, 2008, we were down at 100, okay? So big difference. We're going to keep an eye on it. Big difference though, right? Okay, so just want to keep everything in perspective on what that looks like. So one more thing to kind of give you an idea of what's going on. I've had people ask about, hey, what about the rental market, Chris? Where are we there? So rentals are at 134 square per $1.34 square foot in May. So it flattened a little bit. So it's kind of holding steady there, kind of flattened out. We were much higher than that over the last year or two on average, but that's kind of flattened out now at $1.34 square foot for rentals. So with the rates going up, what will be interesting to see is, are people going to rent, or are they going to buy and just kind of stay where they're at? Can they stay where they're at? What does that look like? So we'll keep an eye on all that for you guys. And if you guys have any questions at all, want to get your information about your area, want us to look into anything mortgage related for you, want us to look into anything on a home value, or you have general questions about purchasing a home, whether it be new or resale, please give us a call. Shoot us a text, 480-788-8569, or you can always email us at home@mincolagroup.com. Check us out at mincolagroup.com or mincolahomes.com. All the links should be here below on social media, or if you're receiving this by an email. If you haven't subscribed yet, please do. You can always do that in the links below. Let us know. We'll put you on our email list just in case. But make sure you follow us on Facebook and YouTube and Instagram. All right, guys, till next week. We'll see you next time. Please reach out with any questions. Hope you have a great Memorial Day weekend. Thanks to all those who are in the military and all those who made the ultimate sacrifice for us and our great country. Thanks a lot. We'll talk to you soon.